Hey everybody, my name is Zach Strobel. I'm with Northern Kentucky University's Center for Innovation and Entrepreneurship. Welcome to part 4 of a masterclass with M&A game changer Dino Lucarelli. Just real quick, the reason that we are partnering with Barnes Dennig is to help promote our entrepreneurship through acquisition program. And what we do is we provide all the essential elements needed to prepare, acquire, and grow a small business. Just a reminder that today, if you are going for the CPE credits, make sure that you respond to the poll questions that will pop up periodically during the session. And then with that said, I'm going to go ahead and turn it over to Dino.
Good afternoon, everyone, and thank you for attending our 4th in a series of 6. Today, our topic will be valuations. Now, again, the poll questions will be there, and we invite you to communicate with us through chat. We're happy to answer questions. So today's session will be pretty complex. There's a lot of concepts we're going to cover, and it's good stuff, but it may be a little bit difficult to follow. So if we're going too fast, or if I gloss over something that doesn't resonate, obviously we're here for you. Please ask questions in the chat box, okay? So let's go on to the first slide. And Ian is our producer today, Ian McManus from Barnes Dennig. So the premise for an M&A transaction is to increase shareholder value. Now that makes sense. That should make sense to everyone. That's why we would do an acquisition. It could be, you know, when I talk about this in the university class and MBA program, I start off without giving this answer. I ask MBA students, what's the reason to do an acquisition? And oftentimes I get, well, to increase sales or to increase market share or a defensive maneuver, or why would we do a divestiture? Well, you know, to get rid of problems, whatever. All the things we do in the M&A world should be to increase shareholder value. And if it doesn't increase shareholder value, you should reconsider what your strategy is. So if you increase the enterprise value net of debt, then obviously you've increased the market value of the equity. There are numerous methodologies for valuation. And so we're going to go through this presentation for about 10 or 15 minutes. And then we're going to talk about concepts. And then we're going to go into a real live example of evaluation on one of our deals. So there are, you know, numerous 7, 8, 9, 10 different valuation methodologies, but the ones that are used most commonly and for practical purposes are a DCF model and variations on that, the multiples model, and a completed transactions method. Now, briefly, the discounted cash flow model is one where we forecast future cash flows and we discount them back at our cost of capital. That gives us the present value today of future cash flows tomorrow. The multiples method is one that most everyone is familiar with, and that's where you just take a multiple of earnings, a multiple of revenue. You say, you know, at cocktail parties, coffee talk, I hear, oh, multiples are 5, multiples are 6. Well, multiples are all over the place depending on the industry. Every industry has its own unique set of multiples because every industry has its own unique earnings trend and revenue model. So it is patently wrong to assume that one multiple fits all industries. And so we'll show an example of a multiple model. And then the completed transaction method, which we're not going to go into much today, but that is one where we look at transactions that occur and we look at the valuation at which they occurred relative to the pre-valuation or pre-transaction valuation. And so you'll typically see a 20, 30, 40% premium paid, particularly when you look at it in public companies. And it's true in the private market as well. It's just we don't really have a benchmark pre-transaction and post-transaction, but the completed transaction method is one where we look at an industry and we say, well, gosh, it looks like transactions that occurred in this industry were at a premium of 25% to the pre-transaction valuation on the stock market. So that's another methodology where you're sort of looking to actual transactions to say that same rigor applies to my company. It's a bit of a stretch, but it's very commonly used in the public company valuation methodology. And ultimately, though, value is a function of expected cash flows. That pure and simple. If it's not going to result in cash flow in the future at some point, it's not something that we should be doing from a merger acquisition perspective. Let's go on to the next slide. So the comparable company ratio approach, which is the multiples approach, it could be a multiple of revenue, EBITDA, or net income. Now, there's other methods that can be used. I will talk about, for instance, I was working with three convenience stores, gas stations. And it was very difficult because there's different models that exist in that world where you have situations where some operators will actually live upstairs in the building. And so they have constant help and their payroll costs are low, et cetera. So I was challenged to look at valuations for three convenience stores. And what I found was that net income was all over the place and EBITDA was all over the place because they didn't have the same general administrative cost structure. But what they did all have in common was a very similar gross margin. Because if you think about it, a convenience store, they're buying from very much the same suppliers, the gas, the fuel suppliers, they're fuel distributors, and there's not much variation from one distributor to another because they spot price their product. And also the things that you buy in a convenience store, that nobody's got the market on, I don't know, beer or whatever, where there's big variances. So what I determined was the most relevant model to use was to look at gross margin. And gross margins were very similar across a bunch of different organizations that I looked at. So I used a multiple of gross margin. So whatever you use, what you're doing is you're saying, the companies that I'm looking at are selling at X times gross margin. And so if I apply X to my gross margin, that would be a fair value for my company. So that's a comparable company ratio approach where you're looking at multiples. Now, the dividend growth model is a sort of a simplified version of the discounted cash flow valuation. And so before we get into the dividend growth model, let me talk about discounted cash flow valuation at the bottom. That's very simply where we're looking at future cash flows and we're discounting them back at the weighted average cost of capital. We talked about the weighted average cost of capital last week. We're going to cover a little bit more of it this week just to refresh. But so discounted cash flow valuation, what you're doing is you're looking at maybe 3 to 5 years out, discrete years, and you're forecasting out saying, I think next year we're going to grow by 15%, and then the following year, maybe 10, the third year, 7, and then we're going to hit a sort of a growth rate of 4 to 5% for the future. So you're coming out with discrete projections from revenue and earnings for the next 3 to 5 years, and then you're coming up with a terminal value, which we'll talk about. With the dividend growth model, you're just using taking next year's cash flow and you're assuming a constant growth of that, maybe 2, 3, 4%, and you're taking next year's cash flow divided by discount rate. It's a quick and dirty assessment. So if you say, well, our company is generally making $1 million in EBITDA, I think that's a reasonable number. So you might say, well, next year we're going to do $1.1 million. And then so your formula would be 1.1 million divided by your cost of capital minus the growth rate. And when you put the minus the growth rate in the denominator, that assumes a constant growth by virtue of whatever growth rate you put in there in the denominator. And we'll talk a little bit more about that. So we'll go on to the next slide. So the comparable company ratio approach, you can look at S&P IQ or various data houses that will give you what the market cap is, what the enterprise value is, and the various revenue and EBITDA multiples that are existing in public companies. So that's easy to find. So if you are in the, let's say you are in the HVAC world, you can find public company HVAC companies and you can see what multiples they're selling at. And then you can apply some version of that to your company's multiples, even though you're a private company. But we'll discount that and we'll talk a little bit more about that. If you go on to the next slide. So discounted cash flow valuation, we've talked about this several times. You come up with the projected cash flows, you discount back at the weighted average cost of capital. So in order to do this, you generally have to prepare a 5-year pro forma under the assumed deal structure. So what do we think we're going to do over the next 5 years? And then calculate the expected cash flows from that. Come up with the weighted average cost of capital, discount those back to time zero, which is day of transaction. The result is the estimated value of the firm. It sounds a lot easier than it is. Okay, let's go on. So this is from last week. The basic formula is the cost of equity. The cost of capital is the cost of equity times the percent equity plus the cost of debt times the percent debt times 1 minus the tax rate, where the cost of equity equals the risk-free rate plus beta times the expected return on market minus risk-free rate plus any size premium. Again, we talked last week. Risk-free rate is typically the 10-year treasury bond. The expected return on the market portfolio is what you would expect your yield on all public equity securities to be. And typically that's ranging in the 12 to 14% range per year. So that's a fairly good number to use, and most everybody uses that, although in a time of ridiculously low interest rates, which we have now, let me level set that. So what we're looking at is what's the expected return on an equity over and above the risk-free rate. So if the risk-free rate is 3% and the expected return on the market is 12, then the market risk premium for the equity is 9%. Now that's a big number. Now I'm going to go back over something I said earlier where I said, you know, the typical expected return is 12%, 12 to 14% on a market portfolio. For valuation purposes, there has been a historical measurement where when interest rates are very low like now, typically the expected return on market minus the risk-free rate, which you see in that parentheses, would generally come to 6 to 7.5%. So that's the market risk premium. It's a premium of what you expect to get on your investment in an equity over and above what you could get if you put it into 10-year treasury bond. And that number typically runs around 6 to 7.5%. It could be higher depending on your risk profile. And then the size premium is, you know, as I said last week, and with what we do, as your company gets smaller and smaller relative to the multi-billion-dollar companies in your industry, there is implicitly and explicitly an expectation that you will be more risky. And so what we do is we add a premium to the cost of equity. We increase the cost of equity for the effect of being smaller, having you know, maybe you have higher customer concentration, you don't have bench strength, you don't have the depth of management, you don't have the number of years in the industry. So you think about the size premium as being an additional, I'll say, penalty to your cost of capital to raise your cost of capital higher. Now what this means is if your cost of capital is higher than your competitors, then you can't afford to pay as much as your competitor can afford to pay for the same company. Because if their cost of capital is lower, they don't have to earn as much to make their bogey, whereas you do. So if your cost of capital is 13% and their cost of capital is 7%, well, all they have to do is make 7% return on their investment. You have to make 13%. So you can see you can't invest as much money and get it on the same return as what your competitors can. So managing your cost of equity and your cost of debt is vitally important to being successful in the M&A world. So let's go on. The cost of debt is similar to cost of preferred equity. Basically, it's an interest on your senior and sub debt and the yield of maturity on your bonds. So if you had preferred equity, your cost of equity is your coupon. Okay, so now let's move on to the tax rate. The tax rate on the new company applied to the cost of debt will reflect the cost of debt net of the tax shield. So the discount rate and the cost of capital, they're interchangeable. So let's go on. We might be freezing up here. Apologies, this Zoom thing, as you all know, everybody who's done Zoom meetings knows we get hung up on some of this stuff. So there are some common pitfalls in applying these methodologies. In the multiples approach, if you pick the wrong peer group, so let's say you're a distributor and you compare yourself to manufacturers, you're making a mistake. But you say, oh, we're all in the plastics business. Well, no, this guy is a plastics distributor. You're a plastics manufacturer. You're going to have very different cost structure, very different expected return, very different customer set. So make sure your peer group that you pick when you use a multiples approach are indeed peers to you. And then oftentimes we see in the discounted cash flow valuation, people will use book value instead of market value for debt and equity. So you say, well, my company's going to be, let's see, my equity in my company, I look at my book, at my, balance sheet, I invested $100,000 in 1990, but now, my company and I invested 100,000, I borrowed 200,000. So that would say, my debt to equity ratio is 2 to 1. Well, no, your debt to equity ratio is going to be based on your current debt to equity component. And that's what you're going to say is you have to decide what, how much debt is going to be in your capital structure, how much equity is going to be in your capital structure, and apply those weightings to the cost of debt and the cost of equity. Other things that can make for big mistakes would be poor pro forma preparation. If you don't prepare your pro forma properly and you use bad assumptions, your valuation will be wrong. And so being able to do valuations means you have to, by definition, be pretty good at looking at your company, looking at your industry, and estimating future cash flows and estimating future revenue, cost of sales, margin, G&A, net operating cash flow, and unrealistic growth rates. We see this a lot, and it's difficult to work with companies when we've been growing at 5% or 4% a year, and for purposes of valuation, we want to go to market and sell the company, and owners tell us that we're going to grow 15% for the next 3 years. Oh, we hit a great spurt. Well, that's a tough sell, and frankly, it needs to be corroborated. If you want to put something out there like that, you need to be able to demonstrate the reality of what can happen. So, for instance, back in the first couple of weeks, we talked about attributes of high-value companies, and one of them was having a good backlog and pipeline measurement tracking process. If you do that, and you can demonstrate that your backlog and pipeline has been growing really fast the last 2 years, you may be able to get away with assuming certain high growth rates in the next couple of years. But absent some evidence to really corroborate that, if you use unrealistic growth rates, you're going to get a really high valuation for your company, and particularly if you're going to sell it. If you're going to sell it, people are not going to believe it. And if you're going to buy it, you want to be really careful about why you would use growth rate that's outside the box of where you've been. These are common mistakes. I urge you not to make them. So we're about, not even 10 minutes in, but what I want to do is I want to go to a live example of, a real valuation, and I want to talk you through it. So here's a valuation where we did essentially 3 different valuations. So we did the economic income method, which is also the DCF, discounted cash flow. We did the dividend growth model, and we did what's called a GF data. The GF data model is, there's a company called GF Data. Essentially, what they do is they give you multiples by industry for various companies of various sizes. And so they take the guesswork out of it. What they do is they actually track multiples, which actual deals happened. And so, we can go out to the market and find the multiples for our competitors as well, or we can rely on this is a shortcut where we're actually subscribing to the service where they show what multiples were actually used for real live deals in your industry, and they track it currently. So they'll show you the last quarter, the last 3 quarters, the last year, the last 2 years. They'll show you what multiples were actually used to do deals. And real live market data is about as good as you're going to get in terms of getting close to the pin. So if we go to the economic income method and you just put your the cursor on D7, so you'll see that that's taken from our DCF valuation tab. If you go to DCF valuation tab, let me show you what we did. So what we have is we've come up with free cash flow. Let me describe the term free cash flow, because it's used in a lot of different places with a lot of different definitions. Think of it this way. From an income statement perspective, we think of EBITDA, or earnings before interest, taxes, depreciation, amortization. Well, that's part of the equation. But as you know, in a business, you also have income taxes, which are real. And so EBITDA ignores income taxes. You also have capital expenditures, and you have changes in net working capital accounts as well. So EBITDA is not the end all be all for discounted cash flow valuation to get the free cash flow. What we do, and this is across the industry of value valuation. There's a concept called net operating profit after tax, NOPAT. So that's in A5. So net operating profit after tax is you work your way down the income statement. Revenue, cost of sales, gross profit, general administrative expenses, and then you have net operating profit. Okay. That's before you have interest expense. It's before you have, which is non-operating, before you have gain or loss on sale of equipment or miscellaneous insurance reimbursements, et cetera. It ignores those, non-recurring things that are not really part of your go-forward business. So we need to get to net operating. What are we really earning? What's this thing throwing off? And then you after tax it. Okay. And, for using after tax, you don't use any particular tax schemes. What you say is, what's my marginal tax rate going to be from what we see over the next 5 years? And you apply that. So this company, year-end 2019, for instance, has a after-tax net operating profit after tax of $568,000. So if you were to go to that cell, go over one cell, Ian, and you look at that comes from our pro forma. So if you go to our pro forma and you look at 2019, you'll see our net operating profit after tax, after adjustments, is $568,000. Now, what you'll see here is we have come up with, we've got EBITDA, and then we have certain adjustments which we calculate, because when we look at companies, very often private companies will say, oh, we have a charity, and we contribute $250,000 a year to this charity that the founder established 50 years ago. And you say, well, that's a discretionary spend that you probably wouldn't do if you were running this company and you're a public company, or even if you were the buyer. So we add back certain adjustments. But anyway, you'll see the 568 net operating profit after tax is very different than the pre-tax income up in line 22. And so without going into all the math, what I'll say is we start with net operating profit after tax. That's the way it's done. And you want to filter out all the things that are non-recurring, that are one-time. You want to filter out interest expense, filter out things that are non-operating expenses. And you want to use that net operating profit after tax. So go back, if you would, to the DCF valuation. Okay. So then you add back depreciation and amortization, because that's a non-cash item. Then you subtract capital expenditures, because if you ignore the fact that you have to inject capital, your assets are depreciating every year. And so you can't just say free cash flow ignores capital spending. And generally speaking, one of the flaws we'll see in many models is we'll see adding depreciation back at a higher level than the capital expenditures are being purchased. That's generally a fallacious assumption unless you can prove why that's true. And even then, it won't hold true forever. Now, if you're in a business that is literally divesting of a capital, let's say that you were a software house and in the 1990s, you were investing in servers and all this heavy equipment. Well, and then you went to the cloud-based, well, then you could see where you could depreciate your equipment and not replace it. But generally speaking, if you see a valuation where your depreciation and amortization exceed capital expenditures over a 5-year horizon, something is amiss. That should be a red flag. You would say that, you're going to bleed the company out. There's no way you can continue to run the company without investing capital if your assets are depreciating or amortizing away. And then the last item adjustment is you subtract increases to net working capital. So let's just take a simple example. Let's say that you made $1 million last year and your receivables increased by $300,000. Well, you may have had $1 million in EBITDA, but since your receivables went up $300,000, you're only $700,000 positive cash flow, right? So if you're in growing companies, net working capital, which is current assets minus current liabilities, generally net working capital is increasing. Inventory is increasing, receivables are increasing faster than payables. So what you have is a growing investment of net working capital in your company, which needs to be deducted from your otherwise free cash flows to look at what's really distributable or available to service your debt and equity holders. So you run that out 5 years. And so you'll see the first year we've got 562,000, and then that grows up to 588,000. This is a fairly modest growth model, but it is growing. And then we have what's called the terminal value. Now, the terminal value is a complicated formula, but if you would go to I-10, okay. So I-10 is what we do is we take the final year's cash flow and you multiply that times 1 minus the growth rate. Okay, I'm sorry, times 1 plus the growth rate. So you grow it, and then you divide it by the cost of capital minus the growth rate, and that then gives you your terminal value. What that number means, and this is pretty complicated if you haven't been through finance, if you haven't been schooled in finance. At first, this seems like a big stretch. You know, if you're saying, so I've got, close to 600,000 a year for the next 5 years, so that's 3 million, and then my terminal value is 4.7 million. So you're asking me to believe that the terminal value of my company is almost $5 million, when over the next 5 years, all I'm going to make is maybe 3.5 to 4 million. Yes, we are. Now, you'll see the terminal growth rate up in I-6, and we're using 0.5%. So we're saying the terminal growth rate, this thing to perpetuity, is going to grow by 0.5% over the life of the company. Now, this is the state of the art. This is the way it's done. This is the way public companies are valued. And so this terminal growth rate is hard to grasp, but it's published. These statistics are published by various data houses. So it's not like we take a number out of thin air. We use information to corroborate our analysis, our assumptions. So then you take those free cash flows on line 10 and you divide them by 1 plus the cost of capital raised to the power of the year. And so when you look at that, 1 plus the cost of capital raised to the power of the year, and then the 5th year, you use the same factor, present value discount factor, as you do for your terminal value. Because what you're saying is you're assuming that the last year, 2024, that you earn all that at the end of 2024, and at the end of 2024, you also have the terminal value available to you. So you discount them both back at the same discount factor. And so then the present value of those cash flows, you calculate those by dividing the line 10 by line 14, and you end up with the present value of the cash flows. You add all that together, that's your enterprise value. Now that's the value of your debt and equity, long-term debt and equity of your company. Now, if you go back to the summary valuation tab, so you'll see that 4.599 number shows up, and it's very straightforward. Now the next one, the dividend growth model, if you go to that D8, so D8, that value comes from the DGM, and so go to the dividend growth model tab where we calculated that. Now this is an easy estimate of the same thing we just did. The last one we just did, we took the 5 years discrete cash flows from a pro forma, which we spent a lot of time developing and a lot of assumptions went into it, and we then calculated terminal value, and we divided that by 1 plus the cost of capital to value of the year. And this is a very simple, simplistic model. What you're doing is you're taking the next year's cash flow based on your estimate for next year, net operating profit after tax, and then you're discounting that back. You're dividing it by an expression which is the cost of capital minus the terminal growth rate, and that gives you $4.7 million. So if you look at that and you go back to the summary valuation, if you look at that, we're not very far off. We're between 4.6 for the top one and 4.74. So we're off by, 1.4 on a $4 million valuation, 2 or 3%. So these are very close. Now the next one is the GF data, which is the multiples approach. So if you click on that, and then you'll see where we reference the GF multiples. So in this one, now we sort of cheated because we have a subscription and we have access to this data, but this is real live data that historically deals have been done most recently at 1x revenue and 5x EBITDA. Now this is not disputable data. This is data that's collected from actual deals that have been done. And these are private deals typically. Now we apply a 20% discount to it because our company is not the same size as those companies. So if you go click on C6, if you look at C6, okay, we just input that straight from the GF data model, but typically we would include the GF data model. So we would show you where that came from. GF data tracks by level of range of valuation. So I think the first range that they go to is from 10 million and 25 to 25 million in enterprise value. Then I think it goes from 25 to 50 million. Anyway, they don't have anything for companies smaller than 10 million. So what we're saying is we generally use an across the board 20% discount. If the company value is much smaller than 10 million, we typically are applying a 20% discount to the GF data multiples. So we ended up using 0.8 for revenue and 4 times EBITDA. And gosh, you'll see it comes to 4.666. And if you go back to the summary valuation tab, well, it's 4.6. So the average of all three of those at some weighted average is right around 4.7 million rounding. And then you subtract out the long-term debt that you have as of the time of the transaction, and the balance is your equity value. Now that's very straightforward. Those methods are, these are tried and true. We're not making it up as we go along here. This is how we do our valuations. This is how valuations are done for a whole bunch of purposes, including, now there are certain methods that the IRS actually prefers, but I've actually been challenged on valuations by the IRS, and they generally, the discounted cash flow model is one that they very much follow. They very much understand it, but these are acceptable, theoretically correct methodologies. Now I want to show some other things in the model just for your benefit. So there's an assumptions tab. If you go to the assumptions tab, and you'll see, if you go to the top and scroll to the top, what we did to calculate our pro forma is we used data that's available from various sources. So we sourced this from IBIS World, which is a data house that we subscribe to, and they talk about what revenue growth rates are going to look like, and we'll make some adjustments to what we think those should be based on our particular company. But we try not to get crazy and use numbers that are way outside the norm for the industry, because it just doesn't hold weight with various buyers. Okay, now if you go to the benchmark tab, about 4 over. So here's another piece of data that you can look at to give yourself some sense about, are we in the ballpark? So if you look at the EBITDA multiple for these companies, these are all large public companies. They're ranging from a low of 4.64 to a high of 6.4. So you'll see when we use 5 or 4 for the GF data, it's not that hard of a stretch. The average of those 4 public comps are probably 5.5, and we're using 4. There's a big discount to, we're discounted at 28 to 30%, and that's pretty reasonable. And then the revenue multiple, we actually used a higher revenue multiple than they're using. And so you look at that and you think, well, is that supportable? Well, when we get into looking at revenue multiples versus EBITDA multiples, there is a fair amount of analyst estimate that has to go into it. You just cannot take the data as is and use it. You have to make certain assessments and to it. So there's a bit of an art to it. I'm not trying to act like it's voodoo, but it's not just rote. When I teach at university, and I have a lot of engineers that come through, and actually the old joke is that accountants are the people that flunked out of engineering school. But when we get engineers in valuation class, they get perplexed because they're used to things being algorithmic. They're used to things being very discrete calculations that come up with an answer. You do it 10 times, you're going to get the same answer. In valuations, you do it 10 times, you're going to get 10 different answers. I'm going to come back to a couple of questions I'm seeing in a minute. So if you go back to the summary valuation again. So one of the things I was trying to go fast to give you a sense of each of the three methods. I want to drill down a little bit into the economic income method and how we did the cost of capital. But before I do that, I see a question. How do you determine the weighted split, i.e. 10 to 90% between revenue and earnings in the GF data model? So go to that. So go to the GF data model. Okay, so we applied 10% to weight to the revenue and 90% to the EBITDA. The reason is that if you look at our EBITDA for this company relative for 2019, so 880 divided by 18. So it's a low number, right? Hold on a second. I'll tell you just a second. So yeah, so it's 4.3%. So if you go back to the comparables, if you go back to the benchmark, okay, and you'll see in the benchmark, let's see if we can find the EBITDA here. Actually, go over to the comps tab, about 4 over to the right. Okay, so you'll see in the comps tab, their EBITDA for the four companies is 1.17 divided by 17.2 billion. So you remember our EBITDA was about 4.4%. Okay, this EBITDA is 1170 divided by 17200. This is 6.8%. So 6.8% versus 4.4%. So this is, almost 50% more profitable from an EBITDA perspective. So this is the rationale. You go, well, our company is less profitable for every dollar of revenue than the peer group. So am I going to use the revenue that they get as a predicate to value my company? Because every time they sell a dollar, they get 7 cents back. Every time we sell a dollar, we get 4 cents back. So what we do is we say, I'm not going to give them the benefit of their revenue being as important in the valuation scheme as the peer group. I'm going to say, the only thing I can spend if I buy this company is cash, as EBITDA, and they're not hitting the same EBITDA numbers that the other guys are. So I'm going to use that as essentially penalize them and use the multiple on the EBITDA rather than gross it up on revenue. It's sort of reverse logic. You go, well, if EBITDA is lower, why would you use it? Well, I'm going to use it because if I use the higher revenue multiple, I'm assuming that my company has the same earnings on every dollar revenue that my peer group does, and that's a fallacious assumption, as we just proved. Okay. Let's, so I wanted to go back and I wanted to hit back, and that was an excellent question. And we get that question a lot. So, if you said, now as a buyer, Now let's think about the opportunity here. Let's say you said, well, the reason your EBITDA is low is you don't do any marketing, you have old equipment, you don't have a service manager, you're relying on product sales, and all you have to do is open up a service division, because let's say that you're already in the business, okay? Let's say that you are in the HVAC business and you're acquiring through growth, right? You're growing through an acquisition. You go, well, gosh, we make 8 points on our company, and so we would install a service department, we would train some service techs, we can get it up to 8%. So you could run the valuation and use a 50-50 split on the GF data, and you're going to get a different answer. So just for the heck of it, let's go back to the GF multiples, and let's go ahead, Ian, put in the weighting down there, right? Put that at 50%. Okay. It just raised our valuation to $9 million. Because if we say that we're as profitable as the average bear, then we'd be worth $9 million, but we're not as profitable as the average bear. So how can I claim to be as valuable as those guys? But that represents your opportunity. If you go in and you can improve the company's earnings potential and get up to the same level or better than your public peers, and that's doable. We'll oftentimes see private companies outperform the public company peer group because they're more nimble, they have faster decision-making, they're not as concerned about short-term quarterly growth. It's not uncommon to see small private companies outperform. But you can see how that one estimate, that in all these numbers, that one change just totally changes dynamic. Now, if you go back to the summary valuation and you look at this, you'll see what a sore thumb that GF data valuation is relative to the other two, right? And you go, well, which is correct? Well, I would say this: if we put into our pro forma for the DCF a huge growth potential, then you would say that would raise that valuation as well. So how we do that? And I don't want to get too tied up in the model, but what I want to do is go back. I'm sorry, if you go back to that, just for the heck of it, we usually do a sensitivity analysis on these deals. So if you take in line 12, if you go to F12 and that 100% performance, if you say, well, what we just did is we assumed for the GF data model that we were going to improve our profitability to the same level that the peer group is. So basically, it's about a 50% increase to revenues or to earnings. If you go ahead and put 150% there, you'll see it doesn't raise it up as high, but it raises up the economic income method higher. So just undo that if you would, because it's going to mess up the rest of our calculations. Okay. So anyway, so that's how we do it. I'm getting other questions. If it is 2020, do results before 2018 really matter? That's an interesting question. I say yes, it does, because what at some level, I think we all have to believe. Now, maybe we don't, and maybe you have a different point of view. I think we have to believe that there may be a new normal, but there will be adjustments back to normalcy, that companies and industries will return back to the pre-COVID performance levels at some level. Now, what I would do and what we're doing in our models is we're assuming 2021 is going to be, ugly as well. And to some extent, depending on the industry, 2022 might be as well, but we're heavily reliant on third-party analysts to tell us that. But generally speaking, if you're down in 2020, we're estimating you're going to be down in 2021 as well, maybe at the same level, maybe a little bit lower. Because if you think about it, COVID really hit us in March. Now it was around earlier. It hit us in March, so we're gonna have 10 months of ugliness in the 2020 numbers. Now, if that were improving slightly as we get through COVID, maybe 2021 per month is going to be slightly better. But you've got 12 full months of decreased earnings. So, we're trying to take it slow and easy and careful and look industry by industry. But yes, we believe that the pre-COVID numbers matter. And it's a case-by-case study. So if you go back to the DCF valuation, I want to hit, again, again, this is the gold standard. I want to hit again on the cost of capital. So if you go up to the discount factor in D14, and then you'll see that that's taken from the weighted average cost of capital spreadsheet. So go down to the weighted average cost of capital spreadsheet, about 5 over. Okay, I want to hit this hard again, okay? We hit it hard last week, but this is the crux of the matter. This is where the rubber hits the road for doing business valuation. The risk-free rate of return, and this was done, I want to say it was in the fall of 2019. We had just taken on this project. We were looking at buying it. We were representing the buyer. And the risk-free rate of return, that's taken straight out of Duff & Phelps. That's based on what the 10-year Treasury note was selling at, 1.55. Yeah, 1.55%. The long-term equity risk premium, again, this is coming out of the software. I told you that historically has been in the 7% range, 7 to 7.5%. And again, that's a published number that's based on historical performance of the equity markets over and above the risk-free rate. So it's not something we made up. It's not something we used judgment on. It's an empirical number. And then we applied the industry beta. Now, do you remember last week we talked about beta? The beta of all the equities in the market are normalized to 1. So if your beta is less than 1, you're less volatile than the market. If your beta is higher than 1, you're more volatile than the market. So the industry, if you look at it with premium and without premium, the without premium these are the large public companies. These are the guys that have a beta of close to 1. And this particular industry has a beta that's slightly over 1. This particular industry, when you put all the industries together, they're going to come back to 1. But our beta is 2.29. Now, where did that come from? If you click on that number, 2.29, which is C5, you'll see that comes from down below. So if you scroll down a little bit, we did a beta adjustment, okay? And the beta adjustment is, we started with the industry beta in B28, and then we adjusted for our different cost of capital structure versus their capital structure. And so you see that the industry debt to equity is about 1 to 3, whereas ours is about 2 to 1. So again, more debt increases the riskiness of a company because the risk of failure, the risk of failing to make payments. So the higher leverage you have in your company, the higher risk you're considered to have. So the way that formula works, and somebody asked for it, I think I put it out there. I gave it to someone to distribute it. But that formula is out there. It's pretty complicated. Not going into it now. But you run it. You can find it in any finance textbook. You can find it in Investopedia. If you re-lever the beta with a higher structure of debt, it comes to 2.3. Or if you were to move that decimal, add one more decimal place to it, that's the 2.29 that we used up above. So if you go up above again and scroll up, so we've got the beta adjusted equity risk premium is 16.3% for us versus the public comps of 8.5. And then there's a size premium, and that's based on the size of our company relative to the large companies. And again, that's a published statistic. We use Duff & Phelps software. These are all numbers we used to calculate manually. They're available through published statistics. But we came up with a size premium of just about 11%. So what we're saying is companies that sell in the under $10 million arena we're going to add an extra 10 to 11% to their cost of capital because of the size, the risk of being smaller, the lack of bench strength, all the things we've talked about. Okay, so if you look at the other premium, we put a COVID premium in, and we're saying that COVID's important. Now it does hit the market, but it's hitting smaller companies. I expect harder than bigger companies because of a lot of customer concentration. Also, the lack of bench strength. If a lot of companies, if you have 10 different service managers for 10 different regions, and 2 guys come down with COVID, you can still cross-pollinate your other regions. If you have 2 service managers in a small company and one of them goes down with COVID, you've got problems. So we're adding an additional premium. So we're saying that the cost of capital for our company, and this is a real deal, folks. This is not something that we're making up. we believe the cost of capital, cost of equity is just under 34% for our company versus 10% for the big boys. So we have a much bigger hill to climb. Our cost of capital is much higher, which means we can't pay as much for that company. So the average cost of debt, we use 3.5%, and we use the same for both. There are small companies that have very good credit ratings, can get, prime or below prime. So I'm not as concerned about the cost of debt. We can get 3.5% from banks right now. And then the tax rate, if it's a corporation, we're looking at 21% plus 7 or 8 for 6 or 7 for state and local, or after tax debt rate. And then you see the capital structures, which we alluded to earlier. And that's how the beta gets levered. So our cost of capital is just under 13 points versus the big boys, it's 8. So the way that's calculated, you say, okay, if you divide D24 by C24, you'll get a number. And that's going to be around 62%. And then you subtract that number from 1. And so that means that we are 38%, our cost of capital is 38% higher than our peers. That's a big number. So all things being equal, they could pay 38% more than us for the same company, and they could make their cost of capital. We couldn't. So I'm looking at questions. Okay. How many peer companies should we take into consideration? As many as you can find without going crazy. We often find 4 to 6. We'll go as high as 8 if we can find them. What matters more than the number is how comparable they are. So this is a matter of analyst opinion. And so for instance, let's say that your company is commercial HVAC and you do commercial HVAC sales and service. But your peer, one of the peers does commercial HVAC for a third of their business, and then the other 2/3 is they do electrical and mechanical. You're not exactly a good peer. So what's more important than the number is try to get peers that are true peers. They're in the same industry. They're very, specific to, if you look at what they do day in and day out, it's as close to what you do day in and day out as you can get. That's more important. But anything less than 3, you probably, need to find some additional corroborating data. One of the things that I wanted to say is if you go, now I know I'm jumping around, but I will share the valuation model for reference. Yes. If you go over back to the summary valuation and you look at this, let's go back to the GF data and fix that and do the 90-10 split that we had. That was 10. Yeah. Okay. So if you go back, what you'll see is all 3 valuation methodologies come in similar. If they don't, and having taught this for 20 daggone years at university and the MBA program, if they don't, you did something wrong. Okay. You're not looking at apples to apples, because unless you think the market is totally inefficient. Okay, now this gets into economic theory. If you believe that the market is efficient, then the market knows, based on historical performance, they know all the factors that went into that. And they're also studying the industry as well, so that people that are investing, analysts and pension plans and fund managers, they're smart people. They know what's going on. They have at least as much research available to them as we do, and they study the market every day. So when they look at the price of an equity, they know all the things that have impacted it, past, present, and future. So if their multiple of what that stock is trading at comes in very differently than what your discounted cash flow model comes in at, you did something wrong. Now, that's a harsh allegation, but I would say if we're outside a 20% differential, if you're more than 20% different, clearly your assumptions and their assumptions are different. They know something you don't know, or you've calculated something wrong. And so I have to stress this with my team as well. If we come in at a different number and those 2 different multiples, so the GF data versus whatever. Now, if you look at we could have done a pure straight up multiples approach which would be the fourth model, which would be based on the public company peers versus the private company peers we use for the GF data. But the GF data is a good, reliable source because those are private companies, and we discounted that back. But if we use the public company peers and go back to the, if you would, go back to benchmark companies. Okay, so if you look at the revenue, or say the EBITDA multiple, and let's just round off and say the average of those four companies is 5.5. And if you remember, in the GF, let's see, in the weighted average cost of capital, we had 38% differential, right? So if you take the 5.5 times 0.62, you're going to get 3.5 to 4 multiple for the multiples approach. Now we'd probably use 4 to 4.5 like we did for the GF data. But what I'm saying is the public company peers would be another methodology we could use, and we use that all the time. So if you go back to the summary valuation, okay, yeah, I will be happy to share the valuation model for reference, and I invite any and all questions. Let's see, what would you say? Critiques. If I have any formula errors, I'm happy to talk about that. I'm pretty confident that it's pretty tight. Okay. Will PPP loans that have been forgiven count as income in the future when calculating PE? No. The way that this PPP loan forgiven issue works is anytime, historically, IRS code would say that anytime you have, you're relieved of debt, the debt is forgiven or whatever, that's a taxable event to you at whatever your marginal tax rate is. What they said with PPP loans is, oh, no, we're not gonna tax you on that. But what we're going to do is the expenses that you deducted, that you paid, that like payroll and rent, you can no longer deduct for tax purposes for 2020, which effectively causes the PPP loan forgiveness to be taxable. So it won't count as income per se, but we wouldn't calculate it as income. But what we would do is, for tax purposes, you're going to get penalized as if it were income. So that's the SBA and the IRS being a little bit out of step, but unfortunately, that's where it is now. I had a conversation with one of our senior partners last week about this, and I think the prevailing wisdom, so to speak, is that there will be a change in that posture from the IRS by the time 2020 tax returns are due. But I wouldn't count on it. I mean, I think there's potential that because what they weren't trying to do is penalize companies for taking the loan. If you're going to give the loan back and you're going to forgive the loan, then don't tax me on the loan as if, if I'm in the 40% tax bracket and I got $1 million PPP loan, that PPP loan forgiveness cost me $400,000, and that's an ugly, ugly situation. Okay, so what other questions? I know there's a lot here. Well, it's amazing. We're right at an hour. It's 2:30. I got through that fairly quickly. In my classes, I will tell you, it takes a lot longer to get through this because there's a lot of theory that goes behind this, and we should rightly challenge the theory. But I can tell you that these methodologies have been reviewed, and every deal we do gets reviewed by banks, and a lot of them get reviewed by other third-party analysts, particularly if an SBA loan has to be reviewed by, the bank has to hire a third-party appraiser to do evaluation. So our models are routinely reviewed and beat up, critiqued. And the simple truth is we do these models to get deals done. We're not doing it for tax purposes. We're doing them to get deals done. We're doing them to demonstrate value to both buyers and sellers. And it's just important to know that these theories are real. Okay, the levered beta is only multiplied times the equity risk premium, not the risk-free rate too. Yes, yes, correct, correct. And if we did that wrong, I'll have to double check that, but yes, the levered beta, you're taking risk-free rate plus the equity risk premium times beta. Okay. What other questions? Okay. Well, I appreciate your attendance. I hope that you find this valuable. I came at this from, I studied it in school and didn't retain it. And as I got into practice, I was in a large public company. And one of my assignments when I was in my late 20s was, I don't know if any of you remember this, we had a systems division. I was at Federated Department Stores. We had a systems division down in Atlanta that was about $150 million cost center. And we were being approached by Ross Perot, that's a name that some of you will remember, who was a data guy, and he wanted to buy the company. So my boss, treasurer of the company, who was a genius, Ivy League Princeton guy, he sends me down to Atlanta to do a valuation. I had to pull out my finance book from 10 years earlier to figure out which end was up. But I encourage you to pay attention to this stuff. And if you are going to be acquisitive or you're going to be in a divestiture mode, that you apply these principles. Obviously, we're around to assist if need be, but this is real. This is not theory. It's based on a lot of theory, but it's real, and it's been subjected to lots of scrutiny by third parties, both buyers and sellers. So if there's any other questions, feel free to hit us up after the session through our email or whatever. But for now, we're finished. Thank you very much. Next week, we will talk about financing a deal. And then the following week, we'll talk about due diligence process. Thanks again, and we are finished.